Good morning, everyone. My name is Jason. I'm a real estate investor based out of the Bay Area. Today, I would love to share some information on how to be a better real estate investor. So let's get started. Specifically today, I want to talk about real estate syndication investing. So a real estate syndication means that you as an LP, you are trusting a sponsor or a general partner here to perform a value add to a real estate deal. So whether this is residential, whether this is industrial or a medical office, you're trusting that this person will be a good steward of your capital. So let's go over some red flags that we want to look for to make sure that they are good stewards for our capitals. So the first red flag that I would like to point out is that you should be trusting the sponsor. So if they don't have any institutional style or sophistication to their fund management, to their operations, that is a red flag. You should be looking at sponsors the way that you evaluate a potential partner. This means that they shouldn't be using their personal Gmail addresses. They should be professional. They should have a team. They should have a group of people around them. They need to really have fallbacks, have systems and practices for how the deal should go. Another red flag that we should look for is unrealistic rent increases in their projections to you. So in the 2023 real estate market, we know that we're having a rough year. A lot of sponsors are inflating the deal numbers in order to make them pencil because the cost of capital is so high right now. So what I want you to do is to make sure that the sponsors are promising realistic rent hikes and make sure that the numbers are working even in tough environments. Another red flag is when the sponsor doesn't showcase their underperformances or losses. This is bad because you want a sponsor who's upfront, who can both show you the positives and the negatives. This way, you will know what could happen with your investments. You don't want someone who's cherry picking only the good performances and gives you a false sense of confidence. So job of an LP is to vet these sponsors upfront to make sure that you evaluate all the risks and rewards of a deal appropriately. Another one that we often see is as a sponsor, expenses on a deal do not pace with inflation. Do you know how hard it is to manage expenses on a real estate deal? Make sure that the sponsor factor in inflation, factor in potential increases in labor costs like we have seen in the pandemic. And lastly, if you see your sponsor using a crowdfunding website or a crowdfunding group, you want to be very careful because you don't know whether how sophisticated the sponsor is. And if they're looking for these small checks from everyone around you, it's probably not a good sign that this sponsor is sophisticated. You want to be very careful and really vet them. Now, I want to share a bit about taxes. So there's two general types of accounts for us to invest in real estate. There is the taxable accounts, which are money that are post-tax, and then there are retirement accounts, such as a self-directed IRA or a solo 401k. What you want to be doing is to minimize the amount of taxes that you're seeing in order to compound your growth. This is really important because of compounding investing. When you factor in taxes every year, your investments grow very slowly. But when you allow your investments to compound and then only get taxed at the very end, you can have a much more advantageous outcome. So what I always recommend is that in your taxable accounts, you invest in high quality real estate and equity like alternatives. This way you can minimize taxable income because what you're doing is growing your equity, and equity growth doesn't get taxed as much as regular income. Now, on the flip side, your retirement accounts are often tax deferred or tax free. This means that you can make notes and collect interest from people, and you won't be paying taxes on those. So we want to make sure that we want to put things that are more like debt into our retirement accounts for us to make sure that we optimize towards our taxes. My personal philosophy for real estate investing is that if it's not a hell yes, then it's a hell no. What this means is that if there's something that you feel in your gut that doesn't work for this deal or this sponsor, you want to avoid it. It's much better to let go of a good investment than to be in a bad investment. The losses will far outweigh your gains. We really want you to do your due diligence, make sure that you check all the numbers, that make sure that it passes your gut check, that you 100% trust the sponsor. Next, I just want to talk a bit about why it is so hard for a real estate investment to work out in 2023 and going to 2024. What has been happening is that the Federal Reserves have been raising interest rates. This will affect the cap rates that we are seeing on our investments. So let's do a very simple assumption. In the bull market case, let's say we start out buying investments with a net operating income of $500K. We are funding $10 million for this project, the investor contributing 35% of the funding in equity. So in the first scenario, we are assuming that the cap rate will be following in the future. This is what happens at a giant real estate bull market when everything goes up. In this case, you see that if the cap rates fall to a 4 cap, because we bought it at a 5 cap, we do make quite a bit of equity. But unfortunately, this is no longer the case with the market. As the exact same net operating income, because of the interest rates and the cap rates for the markets, our properties are valued at much, much less. You can instantly lose 48% of your equity in scenario 2, or 82% of your equity in scenario 3, depending on how the market goes. And real estate is very, very cyclical. Things move depending on interest rates, on macroeconomics factors. There are just so many things that could be affecting our investments. So we really, really want to be careful right now and make sure that we invest in the right deals, that we protect our equity, that we don't lose our hard-earned investments, especially as an LP, because the sponsors, they are going to be getting the acquisition fees. The sponsors are going to get the management fees every year and the waterfall at the end. So they don't have as much skin in the game as you do. What you really want to do is vet the sponsors and just be really careful about how easily a deal can go south. Next, I want to be sharing about some strategies on how to be a good passive syndication investor. In the past meetup, I met this person who told me that they were investing in 20 different deals. And that means that they're going to get at least 20 K1s for the next year. This is a lot of paperwork. This is a lot of stress, especially when sponsors have a delayed K1. And there's always one sponsor where that happens. So what I recommend is first, we invest in low stress options. That's we diversify investments with a focus on consistent returns. Second, I want us to look for long-term partnerships. You are working with a sponsor for the next 5 to 10 years of your life. You want to really vet for someone who you trust, that you can work with in the long term, and not just a specific deal that happens in one time, and make sure that your investment grows. And this is much more scalable than having 2% of your net worth in, across 50 different deals. It's much simpler to only pick 10 and to put more equity into each. And lastly, reiterate that we want to limit our sponsorships to reduce the K1 counts and to focus on a select number of sponsors for the deeper engagements. We want to make sure that we trust our sponsors. I am inherently biased towards funds. We want to embrace evergreen funds and value-driven investments over short-term one-off syndications. Happy investing, everyone.